Fitch just put the United States credit rating in negative watch territory. This is not the first time that this has happened in history. This has actually happened quite a bit, and Fitch warned about this back in March. So what is next, and what do you need to know as an investor in this market? Because let me just let you in on a little secret. If you were not investing in financial markets back in 2011, last time and the first time America has ever had their credit downgraded, the S&P 500 fell 6.5% the following day. So this is a pretty big deal. Let's get into everything you need to know about this crisis, or what could become a crisis. We'll also acknowledge the elephant in the room here in this video, which is Nvidia earnings. Here's the headliner. Fitch puts United States AAA rating on negative watch, citing debt ceiling fight. Quote, the rating watch negative reflects increased political partisanship that is hindering reaching a solution to raise or suspend the debt limit despite the fast approaching X date. Quote, however, we believe risks have risen that the debt limit will not be raised or suspended before the X date, and consequently that the government could begin to miss payments on some of its obligations. If that's not straight to the point of a default, I don't know what else is. They're saying the government might default. That's literally what Fitch just said. This is not the first time that Fitch has warned of a potential downgrade in 2023. On March 6th of this year, little over 2 months ago, the head of sovereign credit ratings for Fitch came out and says that America's credit rating could get downgraded even if a default is avoided. He goes on to say that every few years, Washington plays a dangerous game of chicken over whether to raise the debt ceiling or default on U.S. debt. Even if a default is avoided this time, the frequent nature of these political showdowns could cause America's credit rating to get downgraded. Instead of fundamentals, the AAA rating is really based on America's preeminent status in the financial world. The US dollar is the global reserve currency, and US treasuries are treated as risk-free assets in the minds of investors, two characteristics that give the United States unrivaled financial firepower. But McCormick warns that repeated episodes like the ongoing debate over raising the $31.4 trillion debt ceiling chip away at those two things. The closer the United States gets to the X date of actually running out of money, the more investors are forced to confront the unthinkable, a disastrous debt default. Quote, when investors have to think about that, that's not what you're looking for in a risk-free asset, right? McCormick said, adding that people may want to reassess whether treasuries really are risk-free. Now to the biggest question I'm sure all of you guys have. What does a negative watch mean? Investopedia says when one of the three major credit rating agencies places a company on negative watch, it indicates that the agency has noted a circumstance or circumstances that might cause it to downgrade the company's credit rating in the near future. It is not a sure thing. Once a rating agency places a company on negative watch, there is a 50% chance that the company's rating will be lowered sometime in the next 3 months. Now, doesn't necessarily have to be 3 months. We have 8 days left until we default. Certainly, this could come sooner. It could come as soon as 24 hours from now. But it's telling you that there's a greater possibility than not, or at least a 50-50 chance that you could get downgraded. Now, we have gotten downgraded in the past. Fitch and Moody's have perfect credit ratings on the United States. Standard & Poor's does not, because they did downgrade us on August 5th, 2011. And what happened on August 5th, 2011? If we take it to the charts and go all the way back to 2011, I'm sure a lot of you guys were not investing in the markets. But that was this, almost a 20% pullback in financial markets. Now, on August 5th, you actually did not get this news in regular trading hours. So just like this news of a negative watch being put on America came today at about 7 o'clock Eastern Standard Time, markets were not open. August 5th was a Friday. Coming on Monday, the S&P fell 6.5% the following day. What a downgrade ultimately does for the United States and why it's so negative is it really drives up bond yields. The more uncertainty or the more risk around an asset that there is, the more you tend to get paid out. That's why if you've heard the term dividend traps, well, it's a dividend trap because if you're getting paid 10+% or really over like 6%, how are they paying that out? Why are they paying that out? The underlying asset must be risky. Now, that's why a bond from Brazil is going to pay you out a lot more than a bond from the United States. You're getting less of a yield because it's seen as a lot safer. If America starts to get riskier and the outlook for America and a potential default in the future starts to look more likely, you're going to have higher bond yields. Higher bond yields mean lower valuations for stocks. It's going to mean higher mortgage rates. It's going to mean higher, cost of capital. Revolving lines of credit are instantly going to see their interest rates go higher. Things like obviously car loans, right? Credit cards, everything would become more expensive, would lead to a softer labor market, likely a recession, would lead to lower economic activity in general. Not good, right? Not good for the stock market, not good for capital and capital structure if we were to get downgraded. And that's why this is such a big deal. Some people are going to come out, and I've seen the videos already from CNBC that'll say, hey, Fitch is like the second tier rating agency. If Moody's or S&P downgrades us, well, that's a bigger deal. Well, I beg to differ because you already got downgraded by Standard & Poor's. You're not going to get downgraded again. Moody's, they're probably not going to downgrade America, at least until we get an actual default. Fitch, it looks like a potential downgrade is on the near-term horizon, especially at the valuations this stock market is trading at. It's something to keep in mind and be on the look for because, again, last time we got downgraded, the markets fell 20%. So this is no bueno, not good news. But interestingly enough, you're getting this news after Nvidia reported rock solid, stellar, beautiful numbers. If they come through with this next quarter guidance, game changer for Nvidia. Now, you could argue the valuation is still too expensive, and it's very, very expensive. I wouldn't be buying Nvidia at these all-time highs, but people really liked their earnings. EPS came in at $1.09 versus 92 cents expected. Revenue at $7.19 billion versus $6.52 billion that was expected. They beat by over $500 million. Good numbers right off the bat. But what really sent the stock up over 25% in after hours is the guidance for next quarter. Nvidia said they expected sales of $11 billion plus or minus 2% in the current quarter, more than 50% higher than Wall Street's estimates for $7.15 billion. Absolutely rock solid guidance that you're getting. And if Nvidia can pull through on this guidance, the stock could, stay at these levels. It could go a little higher from here. Hard to say. It's hard to predict where the stock is going to go, but this is very encouraging. Now, Nvidia is basically the epicenter of this AI hype that we have seen. This AI hype has been with the mega cap stocks. By and large, your Google, your Amazon, your Microsoft, all of your mega cap stocks, besides to a lesser extent Apple, have all benefited from this AI hype. And Nvidia is definitely hyping them up, causing the NASDAQ to go up 1.5% in after hours. That is a crazy move for the NASDAQ to move, right? That's huge. So on one hand, you got this very negative news from Fitch, but you got very positive market news from Nvidia. So you got really big push and pull factors that are in play here, and I think this is going to make the data even become that much more important as we do continue to chug along and get more data. Tomorrow morning, 8:30 in the morning, you are going to get GDP price index second estimate for Q2 or for Q1. You're expecting 4%. Last reading was 3.9%. Corporate profits, expecting that at negative 1.3%. GDP growth rate for Q1, expecting that at 1.1%. Chicago Fed National Activity Index expected at 0.2. Initial jobless claims expected 245,000. Continuing jobless claims expected at 1.79 million. Real consumer spending expected at 3.7%. GDP sales expected at 3.4%. Core PCE prices quarter over quarter for Q1 expected at 4.9%, and PCE prices headline for Q1 expected at 4.2%. Pending home sales year over year expected at negative 19%. Pending home sales month over month at a positive 1.4% is the expectation. You have that data coming in at 10 o'clock in the morning, some of that at 8:30 in the morning Eastern Standard Time. Fed Collins speaks at 10:30 a.m. tomorrow, and then you are going to get Kansas Fed Composite Index, expected that at negative 14%. Kansas Fed Manufacturing Index at negative 27%, as well as a 4-week bond auction and an 8-week bond auction coming in at 11:30 a.m. and a 7-year bond auction at 1 p.m., expecting the yields on those to be anywhere from 5% to 3.5% longer out on the curve at that 7-year bond auction. So that is what we are going to have for tomorrow. That is the news that you need to know about this Fitch potential credit downgrade that might just be around the corner, and Nvidia earnings that are really in this push and pull right now. Thank you guys for watching. Hit that like button if you made it to the end of this video. Consider subscribing to the channel, but most importantly, enjoy the rest of your day or night, and I will see you in the next one.